copper in your phone, the coffee in your cup, the oil that powers your car. Commodities are everything and everywhere, and they can also be a smart investment. Understanding what moves commodity prices can unlock opportunities in one of the world's oldest markets. For centuries, raw materials or primary agricultural products have been physically bought and sold and traded financially. Metals like copper and gold, energy like oil and gas, agricultural products like coffee, soybeans, and sugar. Investors turned commodities for diversification. They often move differently to stocks and bonds, and they can act as a hedge against rising interest rates and inflation.
Gold is an instrument that has a very low cost of carry, so to speak, because it has no interest rate. You essentially make or lose money on the basis of the rise or fall of the intrinsic value of the asset. And so we've heard a lot and seen a lot about interest rates around the world, primarily led by the US Federal Reserve. And because they're in a lower interest rate environment and there is an expectation that US interest rates could fall further, that makes gold attractive as an asset with no interest rate.
Several factors drive commodity prices, and canny investors watch out for them. First up is supply and demand. When China's copper consumption drops, prices fall. When Brazil's soybean harvest surges, prices decline. When cocoa arrivals in Côte d'Ivoire slow, chocolate gets more expensive. That can make investing in agricultural commodities in particular a challenge.
It's largely driven by the weather, and the weather with climate change is becoming extremely unpredictable. This year, for instance, we've had really good rains in Asia, so we've had big sugar crops in Thailand and India. So the prices globally are at a 5-year low, so nobody can make money out of sugar at the moment.
Then there's the US dollar. Most commodities are priced in dollars, and when it strengthens, commodities become more expensive for buyers using other currencies. That dampens demand and pushes prices down. Trade policy and geopolitics also have the ability to reshape markets fast.
The Trump administration put tariffs on all the different coffee producers in the world, and particularly on Brazil, which is the leading coffee producer, and the tariffs 50%, which made it virtually uneconomic to ship coffee from the world's leading producer to the world's leading consumer. So it caused a certain amount of chaos in the market. And also in the soybean market, there's been the ongoing trade conflict between the US and China. China's by far the biggest buyer of US soybeans, and they just stopped buying them because of a trade dispute.
These factors explain many commodity price movements, but there's one more piece: emerging demand sources. Copper isn't just about construction anymore. The AI data center boom needs massive amounts of wiring, and that tech infrastructure build-out is reshaping demand in other areas too.
There's a lot of interest in rare earth elements and critical minerals that are used in clean energy transition, mass scale adoption of AI, amongst other things, as well as the traditional uses in manufacturing and steel making and other things.
Futures contracts via institutions like the London Metal Exchange offer investors direct access to commodities, but also direct exposure. They're complex and risky. Exchange-traded funds which track commodities provide access without some of the complexity. For gold, there are multiple routes for retail investors.
Another way that you can invest in gold is to buy something called a paper-backed share of gold. So essentially, that is something called an exchange-traded product. You buy a share in an ounce of gold, which is backed by paper. And what you can do with that, you don't have to worry about storage, and you can choose to sell it, or if you have enough, you can take delivery of it. And there are various venues that you can do that through as well. One of the newer ways of doing things is to buy a digital share of an ounce of gold, and that's very similar to the exchange traded products as well. And then the other common way of being involved in gold is to buy jewelry. However, that does come with a massive markup, which reflects the cost of manufacturing a piece of jewellery and the addition of stones or gems into that as well.
The key is understanding that commodities are volatile. Prices swing on a single economic report, a jobs number, a Fed announcement, Chinese import data. Successful commodity investors watch supply shifts, currency movements, central bank policy, and trade flows. They know that in commodities, timing matters. The market never sleeps, and neither do the forces that move it.